Okay, well, welcome to the June edition of our monthly Sprintlaw webinar. And this month we'll be talking about business structures. And we have our title of the presentation, Structure for Success, Setting Up Your Small Business. Before we get into the legal details, just wanted to introduce Sprintlaw to those who are not already members or clients. We are an online law firm really designed to help startups and small businesses access affordable and efficient legal services. We charge completely fixed fee for all of our legal services, upfront quotes, transparent pricing, and can kind of operate in all the different areas of law from business structures, intellectual property, data privacy, employment, commercial contracts, and more. We have an optional membership, but the majority of our clients sign up to it, and it's a great service if you want an ongoing relationship with us as your lawyers. You get unlimited quick calls with our lawyers anytime you have a legal question or something you're not sure about, discounts whenever you need services, and a bunch of other software tools. We're actually about a month away from launching a really big upgrade to a lot of our member software as well. So it's a really good time to join just before and get access to some of the great features that are coming. And a bit more about our team. We have a bit over 7,000 clients. Lots and lots of positive Google reviews, a growing team of a bit over 50 staff, and we're from and headquartered in Australia, but we're now active in the UK and New Zealand as well. So we're very much a fast-growing legal business. For today's session, we're going to be talking all about business structures. We're going to be covering, what are business structures? Why should you care about them? We'll go through different types of business structures, both simpler kind of structures, sole trader partnership company, as well as more sophisticated structures, dual company structures, trusts, and more. We'll talk a little bit about how to choose which one's right for your business, and also the mechanism for potentially changing your structure and when that might make sense. We'll also touch on business names. What are business names? How do you protect them? And finally, we'll just run through the different legal documents that you need to have in place, depending on what kind of business structure you have. As I'm going through, we've got a Q&A feature in Zoom. Do feel free to use it. We may or may not have some time for questions at the end, but I do like to take questions as we're going through. So do feel free to just ask anything that is relevant to the slide that I'm talking about, or that you'd like to know, and I'll do my best to work it into the presentation. A bit of a disclaimer at the beginning. I'm a legal professional, not a tax professional. So to the extent people have complicated tax questions, I may be able to provide some thoughts, but they may need to be things you discuss with your accountant, particularly in the context of things like trusts. But yes, as I said, do feel free to ask the question anyway, and we'll see what we can do. So starting foundationally, why are business structures important? Why does it matter the way in which you set up your business? Why does it matter whether you're a company, a partnership, a sole trader, all these different models? One way to think of it is kind of like the foundations of your business, the frame of your house. The way you set it up is essential for making sure that your business has the right system, the right protection, the right level of flexibility for your business operations. If you pick the wrong structure, you may find yourself in a situation where you've kind of outgrown it, and it's not fit for purpose, or equally, it's too complicated for what you need. So you just want to make sure that it's the right setup for you and it works for you. And as your requirements change, as your business grows, it may be that the foundations of the house may need to change. But it is that kind of housing for the way that you operate your business. So it's quite a foundational decision in terms of what your business structure is. And as you'll see, it can be a bit of a pain to change. So you want to make sure you select the right one, or if you need to change it at the right time before it becomes a bit more painful. So in terms of the different business structures, some people may be familiar with these, some may not. But in basic terms, when you're setting up a business in Australia, if you want to set up any kind of commercial operation, you're required to register what's called an Australian business number. Apart from hobbies that might generate a bit of income, in general terms, if you're running an enterprise or an operation of any kind that's conducting commercial activities, selling goods, selling services, you need to have some form of registration. And when you go to get that registration, there's different ways to get one. One of these numbers, you can do it as a sole trader, which is the simplest model. It's usually for an individual person who is, consulting or providing, trade services or some sort of personal services to customers. They are providing all of the work themselves. It's kind of just them, and they can register very quickly, cheaply, easily a sole trader. It's free. It's usually instant. It's online, and you'll be given an ABN number, and then you can go out, conduct business, and issue invoices to customers under your ABN. So that's kind of one model. There's the partnership structure. That's sort of 2+ people going into business together. Now, in many cases, as we'll come to in a moment, when 2+ people go into business together, they may actually choose a company structure or one of the more sophisticated structures. But one choice for people as well is to set up what's called a partnership, and that's when two or more people basically join forces, almost like sole traders, but they're working together. And they'll sign usually an agreement to agree to collaborate, and together they can get a joint business number and file a joint tax return and sort of run the business together. Then we have the company structure, and the company structure is sort of the more formal way to set up a business. When you set up a company, what you're doing, which is a little different to a sole trader and partnership structure, you're actually setting up a separate legal person, a separate legal entity called a company. It's actually separate from the people that set it up. It's got its own identity. It'll have its own bank account. It may enter into contracts as the person that signs at the dotted line. And it will have directors who are kind of like the arms and the brain of the company that will control what contracts it signs and what it does. And then it has shareholders that are kind of like the body of the company, so the people that kind of own it. But it is itself a separate legal person. And the big fundamental difference with the company from, for example, the partnership model or sole trader model is, when you're a sole trader, it's still you just with a business number. When you're a partnership, it's still just you and your partner kind of working together jointly with a joint business number. When you're a company, it's actually a separate legal person you've set up. And this separation matters because it means, in legal terms, the liability is completely separated from you as an individual. The company might get in trouble. The company might get sued by a customer. The company might have issues with his bank account. But with some exceptions, in general terms, the directors and the shareholders, their personal affairs are separated from the company and may not be affected by issues that occur in the business. Whereas when you set up a sole trader, if you have an issue with a client or a customer and they decide to sue you, well, there's not really any separation between you and your sole trader business. So your house, your home, your car that you own personally can be on the line for your sole trader services you provide. And same with a partnership. Even though you may think we're a partnership, we've set up a separate business. It's really, in legal terms, just two sole traders joined at the hips, or two or more sole traders joined at the hips. And again, their liability is connected. And if something goes wrong, in equal terms, usually each of the partners, houses, homes, guitars, whatever it is they own, can all be on the line. So, as lawyers, a big part of what we do is help our clients avoid risk. And we are very keen on the company structure generally. As we'll see in the moment, there's pros and cons and costs involved. But from a risk standpoint, having that company as a shield between you, your business and your personal affairs is a significant advantage. And so a lot of businesses, particularly when they hit a certain point of scale or seriousness, will end up moving to a company structure. Now we've got some more complex structures for those that either already have companies or contemplating setting them up. When you set up a company, you don't just have to set it up as what we call a single company structure, where you have one company for your business, and then that one company kind of does everything involved in your business, and then you have the directors and shareholders that direct and own it. It is common to do it that way, but there is an option of setting up multiple companies. So we have in the middle an example of what's called a dual company structure. And this is particularly common for larger businesses or smaller businesses like startup companies that are intending to scale and become larger. or organizations with sort of different departments, different areas, where a single company structure may not make sense. And so the advantage of splitting up a company structure is, we said earlier on the previous slide, well, when you have a company, you've got a separate legal person. It has all of its risks separate from the directors and shareholders. So it can get sued. Its assets can be at risk, but that doesn't affect the directors and shareholders' interests. Well, that's all well and good, but over time, as your company becomes more valuable, some of your company assets you might want to be protected from risk as well. So what you can do when you start setting up multiple companies, and we have this example in the dual company structure, you can have what we call a holding company. So a company which has all of your high value assets, maybe your core intellectual property or large cash reserves or really important assets. And it can then own another company, your operating company. And that's the one, that legal person, the operating company, is the one that goes out and runs the business, employs people, enters into contracts. The advantage, of course, is if the operating company does something wrong, it suffers liability. Its assets will be at risk, but if all of your business's key assets are held in a different company, your holding company, then you're at a lot lower risk for those assets. And so, particularly in the case of startup companies who are often developing, really critical IP or holding large volumes of cash if they've raised capital, an advantage can be to put those assets inside the holding company. And if they make a mistake in their operating company, there's an issue with an individual client or employee or something goes wrong, it's not like the whole business may be at risk or necessarily collapse because a lot of the risks are siloed into that holding company structure. We've got a couple of questions in the Q&A relevant to what I'm talking about, so I might just address them. So Rishi's asked, should vehicles, movable assets used to dry hire be in a separate entity from the main trading entity? So look, it's a decision for you as a business, and it depends on the value of those assets and what appetite you have for the additional costs, which we'll come to in a moment, involved in managing multiple entities. If you have high value assets, similar to what I was just saying, it can make sense to put them in their own entity to protect them from risk. You can think of having a dual company structure, and when I say dual, you can have multi-company structures with 4 or 5 different companies all separate from each other. It's a similar concept. You can think of these companies as like safety deposit boxes where you make a mistake in the normal operational trading of your business and there's some liability. If all of your core assets are stored away in one of these holding company or other entities, it means that people may be able to sue you, but they won't be able to claim the high value assets. So the advantage of moving those sort of dry hire assets to another entity, it just protects them from being vulnerable to risk if you make a mistake in your trading entity. So obviously there's cost in setting up the new entity, but if the assets are high enough value and you want to protect yourself from risk or mistakes you may make in your main trading entity, there's a good argument for doing that. We have a lot of clients that do dry hire, and some of them do that, some of them don't do that. Often a consideration is just the cost of an administration of having 2 companies, and they feel that the risks are not that high. But certainly the larger operations with large asset pools and more customers, it starts to make more and more sense because you have significant assets at risk. And again, you don't want one issue with one customer to put millions of dollars of assets at risk. So yes, those are the considerations. Ultimately, it's a decision that the business team has to make in terms of risk and complexity. But as risk-averse lawyers, we do like the idea of multiple entities and protecting them that way. So definitely something to consider. Basim has also asked, under what circumstances can a director of a ACN, which for those that don't know, is just the Australian company number, so director of a company, be sued separately from the company? So yes, I did say, kind of in passing earlier, I was talking about the advantages of the company structure and how the big advantage is when you have a company, you don't have personal liability. But I used the word generally, and so Basim has helpfully asked, what circumstances does that not work? And still, you as a director or potentially shareholder are liable for mistakes made in the company. Well, shareholders are rarely liable, but directors, whenever you become a director of a company, you are required by law to abide with what we call directors' duties. There's a handful of them. You must avoid conflicts of interest, exercise your position with due care and skill. You can't commit fraud, et cetera, et cetera. And the way the law works is if you breach one of these director's duties, you can be personally liable as a director. It's an exception to the general rule that companies protect directors and shareholders from personal liability. The only real exception is if you're breaching one of these directors' duties, if that makes sense. So it is important when you set up a company to do some reading on what are my duties as a director. And to the extent that you're setting up companies for fraudulent purposes, you're deceiving end customers and moving money around in ways that isn't lawful. You can't hide behind the fact, oh, it's the company that did it. You can have what we call in legal terms a piercing of the corporate veil, where the law will break through the protection of a company and hold the director liable. So there are circumstances. ASIC's website has some really great pages explaining in simple terms what are directors' duties. And I would encourage anyone who's setting up a company structure to just have a read of them. There are courses you can do, to become a director and all these sorts of things. I would say the majority of small business company owners don't go through the cost and expense of doing the full director's course. It makes more sense for larger companies with larger risks and more sophisticated matters. But at minimum, it's still worth being aware, whether it's just by reading on ASIC's pages and otherwise, as to what those duties are, because of course you want to make sure that you are protected. You can get additional insurance, what we call director D&I insurance, which protects directors in particular from those exceptional liabilities. So that can be another way to close the gap. Avoiding things like being fraudulent and things are very important, of course, as a director, to make sure you maintain that limited liability. So hopefully that makes sense. So coming back to this slide, we talked about the dual company structure. We have on the right now the trust / company hybrid structure. So in addition to the structures we mentioned, people may be familiar with the concept of a trust-based structure. And there are many variations of trust-based structures. You can have things called discretionary trusts, you can have things called unit trusts, and you can mix trusts with companies. And there are various reasons for incorporating trust into your structure. I won't go through all the different machinations of trust structures, but high level, the two main purposes for incorporating a trust into your structure are, number one, additional liability protection on top of what I was just talking about in terms of company protection, and two, certain tax advantages in the way that funds move from the business to the individuals. It does add more cost and complexity to incorporate trust into your structures, but you do see them recommended in particular by accountants for tax purposes, as well as lawyers for liability purposes. So just to give you an example of how a trust can fit in to a structure, and the structure on the right sort of reflects actually how we set up Sprintlaw eventually over time. So it is a common structure used by startup companies. So you still have your dual company structure. You've got an operating company, you've got a holding company. But instead of the owners of the company, so the shareholders of the company being the individual business owners, as we have in the single company and the dual company structure, the founders of the company may instead hold their shares through a trust company. And what that means is they're not direct owners of the shares, but they have an entity which they control and can direct, which holds their interests on trust for them as individuals in the company. And so what that means is, the funds, dividends from profits, or if the company is sold in the future, the dividends from the sale of the company will flow into a trust company structure and can then be distributed to the business owners, other individuals, maybe family members, as the money comes through. And so the way that money's taxed can be different. It may be that when the money flows out of the company, the founders may want to distribute the funds for other purposes before it sort of hits their individual income. And in that way, controlling the sort of flow of funds from the company to the individuals can have certain tax advantages. And it may be that, you want to release funds from the company over time. Maybe you don't need the money now. And, maybe you don't want to be in an extremely high tax bracket this year. So a trust can give you some advantages in terms of how the funds are distributed. So that's the tax advantage. And again, whether that makes sense for your personal situation depends greatly on your income sources, your family's income sources, if you use a family-based trust structure, and other factors. So it is always best, if you want to set up a trust for tax purposes, to have a conversation with your accountant about whether it might make sense for you. From a legal perspective, the way that the reason we like the trust structures are for the risk component. So you can see in the single and dual company structures, you've got the shareholders that own the companies, so the shareholders are protected from liability from end employees and end clients. But up the top of the picture, usually the shareholders are contracting with each other individually, and we'll come to in a moment. Typically, a business partnership agreement signed when a company's set up, we call it a shareholders agreement. Usually the people that set that up just sign that as individuals. So while those individuals are protected from liability from employees and clients, if business partners decide to sue each other because the relationship breaks down, well, there's no company between them because they entered into the relationship to set up the company as individuals. So there's actually a vulnerability, particularly in partnerships, if in a company structure where the owners don't have some entity just for themselves. So the trust can serve as also as a further shield. And you can see in this structure on the right, we've got the operating company. That's the risky company that goes out and does business. We've got the holding company which holds a lot of the assets and keeps them free from risks. Then each of the founders may have their own individual trust companies, and then we have the founders right at the top. So if there's a dispute between the founders in relation to the company, their trusts can go at each other, but the founders themselves are still one degree of separation away. So their personal assets may be more secure from risk. So you can view this as a series of shields from risk for ultimately the business owners. They've got the trust protecting them from risk with other business partners. They've got the holding company, and then they've got that protects their key business assets. And then finally, they have the operating company that goes out and does all the risky business. So again, we'll come to in a moment. There's costs associated with this. You can see there's at least 4 companies in here, and companies cost money. And so there is a cost to setting this up, and it may be that if you're running a smaller scale operation, it doesn't make sense to have this much complexity, but you also hopefully understand some of the conceptual advantages of introducing trust into your structure if it may make sense for you. We've got a question. Is there a sole trader / trust structure? If so, can you explain it, please? Sole traders are a very specific thing, which is different to a trust. It's a type of registration where you're operating as an individual, and trusts are basically a relationship that an individual sets up with either another person or an entity, and so there's has to be 2 legal individuals involved, whether that's a person or a company or two people, and one person's acting on trust for the other. So they're different concepts. What you may be asking, though, is it is possible to have a trust structure without having a company. And we do see small businesses set up just as a single trust. They don't have a dual company. They don't even, in some cases, have a single company. They just are like this level here. They're just an individual trust set up for a business owner. When you use that kind of structure, you do get some of the tax advantages that I was mentioning in terms of a trust. That's really the only reason to do it that way. We're not huge fans of that structure. It is recommended a lot by accountants because it does make succession planning difficult. You've kind of mixed your personal tax affairs with the affairs of your business. A trust is very much something that you may want to control for personal matters in terms of how you distribute the funds between you and potentially your family, which is quite different considerations to how you may run the company. And particularly if you want to sell the company in the future, its assets and the way it operates may be quite different to the individual trust. So it can be done. Some people do it because it's cheaper than setting up multiple companies. But not something that at least lawyers love all that much. But for those that may have structures like that, it's usually because an accountant recommended it, and it does work. It just has some of the disadvantages that I mentioned. Basma's asked, can you be both trustee and beneficiary of a trust company? Well, typically when you set up a trust, you have a company, as we have on the right here. A company is set up as the trustee of the trust, and the beneficiary is the individual. For example, in Sprintlaw, I hold my shares through a trust. Now I have a company, the Alex Solo Trust Pty Ltd, and I have myself as an individual, of course. And so the company, when we set up the trust arrangement, the company is the trustee, and I am the beneficiary. And so, in a sense, there's no third parties needed to set up this trust structure. But in legal terms, the trustee and the beneficiary are different people, because the trustee is my company, which, as I've been describing, is kind of like a legal person. And then the beneficiary is me and any other individuals in the future I may appoint. So yes, you can set this up yourself without anyone else. In technical terms, it's not you that's the trustee and the beneficiary in a company context. It's the company that's the trustee and you as the beneficiary. Haley's asked, what if some of the directors want to leave, withdraw? Can the remaining ones still be able to run the company? In our case, we have 4, 2 of them want to leave, and can we still run the company? Absolutely. One of the advantages of a company structure as opposed to a partnership is, when situations like this emerge, you can, with a company structure, people will own a stake or shares in the company, which, if you work out what the total shares are and their ownership stake, you can work out what percentage they own. So people will have different percentage ownerships of a company, but their shares can be sold, and they can be sold back to other shareholders. They can be sold to third parties. Typically and ideally, and I'm not sure, Haley, in your specific case, you may want to get some legal advice, but ideally there's a shareholders agreement in place of some description that talks about, and this is a contract that you set up when you form a company, talks about what happens if people want to leave, what the procedure is, and who they can sell to. They can't just go off and sell their stake in the company to some random person that no one wants involved. If there isn't one of those, then theoretically that kind of stuff may be possible. But a common scenario when 2 want to leave is there's some discussion, assuming it's all amicable with the others. We will pay you X dollars to buy your stake in the business. You will sell your shares back to us. Then the 2 that leave, would agree to sell their shares to the other 2. ASIC would be notified. Dear ASIC, this company is now owned by 2 people instead of 4 as of this date, and you sort of part ways, and you might get a release form and liability waiver signed by those that are leaving to protect the company from future risk. But the company is a separate legal person. It can live on irrespective of who's controlling its arms and its body, and that's one of the advantages of I guess the company structure for flexibility. Yes, if you want to get specific advice, Haley, on the legal steps required, do feel free to reach out to our team. But certainly it's possible if you have a company structure. We've got a question. What is your definition of a small company, less than $1 million? So I assume, in relation to, as I've been speaking so far, I've been saying for smaller companies, it might not make sense. For larger companies, it may make sense. It's a very subjective definition of small. And certainly, when we set up Sprintlaw, within 6 months, we went for this very sophisticated structure when we had, almost no revenue and no employees. But we knew we wanted to grow to a larger organizational structure. We'll talk in a moment in terms of the advantages and disadvantages of different structures. But it was clear, at least in the case of Sprintlaw, that pretty soon we wanted to be a larger organization, and this structure would give us future proofing. For other cases, we have clients that run small businesses, cafes, restaurants, with 2 or 3 employees. They may not have the requisite desire to deal with the complexity of a company structure. So they choose to operate in a partnership model, or even in some cases a sole trader model. But equally, you can have consultancies that are doing same number of people, 2 or 3 people, but they're doing extremely high value projects or high risk projects. Maybe they're making the same revenue, and they choose to go with a company structure because they're worried about risk. So it's not just about dollars. It's about maybe future ambitions and goals. It's about risk in terms of the type of work that you're doing. It's about appetite for complexity. There's a few different factors. Typically, larger companies are riskier, have more sophisticated operations, and are probably trying to grow more actively. And so they tend to, exclusively choose the company structures, whereas it's more common in small businesses to not necessarily have those same considerations, but it all depends on the specific circumstances. And hopefully in the coming slides, I'll do a good job of explaining to you the pros and cons so you could make a decision for your specific situation. Maria's asked, can we have one single trust for several founders? What are the risks? Yeah, it's similar to what I was saying earlier. You can do that, but it rarely makes sense, because, as I mentioned, one of the main advantages of the trust structure is individual protection from other founders, and another advantage of the trust structure is personal tax flexibility to have funds distributed at different times. So when you are all combined into a single trust, you're not really getting either of those advantages, because you're all under one trust structure. So it may not make sense. There is a structure called a unit trust structure that's, again, often recommended by accountants. It can sometimes make sense where you set up a trust, but you create almost like shares in the trust. And often in the unit trust structure, you have another trust underneath the unit trust. So it's like a single trust on a trust. And again, you can tell already from how I'm describing it, it can get a little complicated, but you do see some scenarios where there is a trust for multiple founders. And again, the only reason to do that will be some recommendation based on the personal tax affairs of each of the founders. I would say it's uncommon and not commonly used by small businesses. But again, maybe a way of achieving some benefits more cost effectively. So again, if you're interested in that, always best to chat to an accountant and just see if it might make sense for your situation. Okay, so let's now have a look at different types of structures. And we have a little bit of a heat map here. I won't go through every cell because I'm sure people will fall asleep, but you could just see from a bit of a snapshot. On the left, we have things like cost of setup, ongoing compliance, complexity, control. It's the sole trader and partnership models, cheaper, easier setup, lower ongoing compliance. However, you can see a sea of red towards the bottom. When it comes to risk, much higher. When it comes to raising investment, much higher. When it comes to credibility, and it is a perception in society that companies are a more sophisticated business operation, for better or worse. That these structures, may have lower credibility. If you want to continue or sell the business beyond, what its current operations. As we said earlier, sole trader is just you. Partnership is just, you and others working together. There's not a separate concept of a legal person that operates the business that could be sold. Ownership of it could be sold. So more difficult to sell. And then tax disadvantages, which I haven't really talked about in much detail yet, but depending on the income of your business, the company tax rate is 30%. Depending on how much your business is earning, it may work out to be more tax effective to be a company than a sole trader, or vice versa. It's a consideration, but it can be flattened for a company. So we then on the right, we've got the other extreme, the trust. We saw on the right that there's many structures often involved in a trust/company hybrid structure. So the costs are higher, the ongoing compliance is higher, complexity is higher, but you have really strong liability protection. It's great for raising capital. Credibility is high, of course. And in particular, you have potential tax advantages in the trust company hybrid structure. And you can see in the middle that the company, single company and the dual company, if you just look at this picture and the factors that we've chosen, are, the most common, they're a good balance of everything in terms of they're not that expensive, and they give you quite good protection in various areas. And so, again, to the earlier question, what is small and when should I be thinking about these structures? You can see roughly over a business's journey when you really are very tight on cash and you have to be riskier, you might begin with these sole trader partnership structures. But when you can afford it, and as you get a bit more sophisticated, there's big risk advantages and long-term advantages to being in these other structures. And so when you can afford it, you may want to move to them. And certainly, to be more specific about exactly how much it costs, a company registration, ASIC charges a little under $600 in government fees to register a company. If you get legal help from our team, I think we charge another 500-ish on top, probably cheaper at the moment with the discounts. So you're looking at $1,000-ish to set up a company. So it's not $10, but it's not tens of thousands of dollars, and you're getting a lot of benefits. So it is. And then, there's ongoing renewal fees of a couple of $100. There's company tax returns. So, you're looking at a few thousand probably each year in additional costs. So again, it's not nothing, and you may or may not be able to afford that. But it's also something that a lot of small businesses can afford, and it really has all these big advantages in terms of liability, credibility, and so on. And same for the dual, dual twice, like double the cost for registration. It's a bit cheaper when you do two at the same time. The compliance is pretty similar. The complexity is not that much more, and you have that additional protection of your assets. So yeah, that's a good kind of way of thinking about it. Now, there are, in addition to these structures that we've been covering, other structures. If you're running a charity or non-for-profit, there are certain structures, both state-based and federal structures that you can use to set up your business. You can register also for DGI tax status in some cases. In the interest of time, I'm not going to go into them in great detail, but there are some of what I said does not apply to not-for-profit structures. So if you're setting up a not-for-profit or interested in that, you should definitely get some specific advice about that. There's things called unlisted public companies. And there's obviously listed public companies, things on the stock exchange. Again, not super relevant for small businesses, but they do exist. And these businesses are a bit different in the sense that, they have large number of owners or shareholders, and at some point, regulations start to be introduced in the size of companies to, be more transparent with the owners who now may be so abstract from what's going on in the business that they don't know what's going on. So you may hear of those, again, not usually applicable to smaller businesses. And there's a new structure, equity crowdfunding or crowdsourced equity financing, relevant to startups in particular. It's a type of structure which is, you're still a company structure, but you make a couple of changes to the way that your constitution is set up, and it enables you to do some online fundraising through the equity crowdfunding process. And again, a lot of what we covered still applies to equity crowdfunding structures, but there's a few other considerations. So again, if you're looking into doing equity crowdfunding, definitely worth getting some advice on that as to, whether it makes sense for you and what structuring implications there might be or changes you may need to make. So I covered this a little already, but just to kind of summarize, which one should you choose is the big question. And I think, here's what you want to think about. Number one, liability. If risk is a big factor for your business, and that may depend on the nature of your business. If your business involves high risk activities where people might seriously get injured, or there's a probability of something going wrong all the time, it's very risky to be a sole trader or partnership structure because liability could be significant. Of course, you can get business insurance, and insurance can help sole traders be more protected from liability, can help companies be protected from liability, but insurances only go so far. They've got limits, they've got exceptions. So really high risk businesses on one extreme, you want to be thinking about this. Extremely low risk businesses, you might say, well, look, I can wait a little longer to set up a company because I really think in what I'm doing, it's very unlikely I'm going to be sued by a client. So maybe you take the view that I know there's risks, but I'm going to wait until I'm a little, more able to afford some of these additional costs. And then there's every business that falls somewhere in between those two extremes. So it is somewhat a personal decision, somewhat a sensible decision based on risks. But again, lawyers being risk averse, we would say, even if you think your business is low risk, if you're out there working with clients every day, all it takes is 1 in 10, 1 in 20 things to go wrong, and you'll wish you had the company structure as protection. So that's, I think, a big consideration is liability. I want to sleep well at night knowing if something goes wrong in my business, it's not going to affect me. Cost is the trade-off, of course, right? So I want liability protection, but I don't want to, control, 7 business entities and pay thousands of dollars. So you've got to trade off how much liability protection, how much am I willing to spend? And so again, I've made the point, the sole traders and partnerships are cheap and easy to set up. Dual companies, trusts, more expensive. Companies may be a good middle ground if you can afford them, but that's what you're trading off. Liability protection with cost. Control, who's going to control the business? If you have investors, other stakeholders, and split control in how the business is going to operate, if that's how you want to run, I mean, first of all, you just can't be a sole trader because that's a one-person structure if there's multiple people involved. So then you're thinking about partnerships versus, companies or multiple companies. And again, partnerships really are just a few people collaborating and working together. Once you have businesses with different investors and different stakeholders who may not work in the business, but they may put money in the business, it becomes very difficult with partnership structures. And a company structure, again, is well set up with the concept of percentage ownership of this fictional legal person. There's contracts that get put in place. So if you need more sophisticated control mechanisms, you may need one of these more sophisticated structures. Or even if not now, if you intend to have them in the future or want to be ready for them, that's another reason. One trigger point, particularly for startup companies, we see they either want to get like some kind of loan or equity capital financing. That can often be a trigger point to set up a company. It's certainly if you're raising equity funding, so selling a percentage of your company to investors, it's really the only way to raise capital. You must be a company structure. And particularly for startup companies, a lot of investors prefer the dual company structure because, again, they want to know that their investments are safe from mistakes that you might make in the day-to-day of the business. So that's another reason. And finally, we've already talked a little bit about tax efficiency, and depending on the level of income that you have, there are these tax advantages to the company and trust structures that may or may not make sense depending on your level of income. So those, I think, are what you want to be thinking about. Just, do I have the right structure for cost, liability, control, funding, tax efficiency? And of course, lawyers and accountants can help you zoom in on that decision, but ultimately it's one that you want to be thinking about yourself. Rishi's last question: is it cost effective to own assets in my personal name, my trading entity, try hire to my customers? If I hire between my company and myself, does it give me asset protections? That might be a little too specific a question to your circumstances. So I would maybe encourage you to reach out to our team. If you're a Sprintlaw member, you can book a call and one of our lawyers can chat to you. I can just say in general terms, if you're thinking instead of a holding company, operating company structure, can I just have a company structure and then I as an individual own everything and then they're separated? That is true. However, I'm not sure whether there are other potential tax or other consequences in essentially holding business assets in your personal name, where they really are meant to be used for the business, and it may affect the way you could use those assets in the future. So again, probably need some specific advice, but it may be more complex than it seems in terms of doing something like that. Oftentimes, and it's the case for a large number of our clients, we do presentations like this, and then they think, well, I'm not sure I have the right structure, or people have been meaning to change over time. So the need to change structure happens quite often. Another question that we often get is, think I want to be a company or a dual company or a trust in future, but right now I can't really afford it. So can I just go with the cheap one and go to the more expensive one later, which is a reasonable question to ask. I think what does changing look like and when does it happen? Changing does happen all the time. It's not painless, and we'll go through in a moment the process of changing. It is like moving home in a sense. And you got to get the movers in and move all the furniture and reconfigure everything and change your address and all this kind of stuff. It's a similar analogy to changing structure. It can be a headache, and it would be nice if you had the right structure from the beginning, but it's certainly possible. So the trigger points and where we often see businesses change structure. Number one is you've just grown. You maybe you're operating as a sole trader or partnership, or maybe you're raising funding, and maybe you want to recruit staff and you don't want to be a sole trader. You want to be a proper company, if you will. Maybe your clients, you're working for larger companies or whatever it is, and it looks better to have a company on the invoice. These kinds of triggers are reasons why people say, look, my business is becoming quite serious and I just want it to be more formal now. I want to separate it and so on. So that's often what you might call a vibe change in the business when it grows is a reason, a common reason that we see businesses change from at least sole trader and partnerships to company structures. And similarly, we see single companies move to dual companies and trusts when companies are either have more significant income or they're raising funding and they want to have again a more sophisticated structure that's ready for growth. So that's one trigger. Liability concerns is another trigger. If your business has, if you have, personal assets you want to protect from business risks, you want to sleep better at night. Again, setting up that company structure is a great way to protect yourself from personal liability. And I'd say that's another big factor. Businesses are growing, people are getting worried about things that might go wrong, and they just want to have that separation. And similarly, if you're already a company, again, we see in some of the questions I think we've already had in the Q&A, you've got high value assets in your business and you've only got one company and you would now want to split them between different companies to silo your risks more. So again, it's a risk thing. Every time you set up a company, it's its own silo of risk. And if you move assets into other places, you end up protecting those assets more. We've got succession planning. I mentioned earlier, you can't really sell a sole trader. I mean, you can sell the assets of the sole trader business and the goodwill and so on. It is possible to sell partnerships and sole trader businesses. But if you want business continuity, it's much smoother, much easier to have a company structure. We had a question earlier about, 4 people in a business, 2 want to leave. With a company structure, it's set up for that stuff. You can swap out the owners and bring in new owners and people can leave and things like that. In sole traders, obviously, it's one person. It's not possible. In partnerships, it's much more difficult. Essentially, partnerships agreements have to be redone every time someone leaves, with some exceptions. So it's much better, and you can sell the business in future and et cetera, pass it on. So great for succession planning. And finally, I think we've talked enough about the tax efficiency, but that's another trigger that we see people wanting to get the tax advantages and the lower company tax rate in terms of moving to the company structure. Kwame's asked, can you move from a single company to dual company under the same ABN? No, yes and no. Typically, when you move from a single company to a dual company structure, there's 2 ways it can be done. Either this original company becomes the holding company and you set up a new company underneath it, or this company becomes the operating company and the directors and shareholders sell their ownership to the holding company and kind of move up here. But that's more sophisticated. There can be tax implications. So it's more common that you would set up a company just underneath this company, and so the current company becomes the holding company. There's downsides to that in case there's risks from old school risks in this business that might come back to haunt the holding company in future. So sometimes you don't, but that's probably more common. And in that case, the operating company is a new company, and a new company will have a new ABN number. You can't really transfer ABNs. They're specific to companies. So that's kind of how it works. And then Basma's asking, can you please explain how a holding company operates? Yeah, I covered a little bit of that earlier, but just to recap, the holding company is kind of like a sort of dormant company that just exists to hold your assets, your capital, your IP, your cash. It's like your safety deposit box. And your operating company is the one that signs contracts with people, signs up to software subscriptions, employs staff. It's the one that does all your business. It's the one that has its accounts. But it's actually not owned by the directors or sorry, it's not owned by the ultimate shareholders. There's something in between called a holding company, which owns it and may hold the critical assets. And so this just means that the critical assets are safe from risk that may occur in the operating company. Whereas when you just have one company, everything's all together. So if something goes wrong with an employee or under a contract, those assets become at risk. So back on changing business structures, we talked about the trigger points for changing. So what does the process look like? How painful is it? This is roughly what it looks like. It will depend on which structure you move to. Obviously, you're going to choose the new structure. Am I going from sole trader to company or company to dual? Then there's going to be some new documents that need to be prepared, company constitution, shareholders agreements. Then you'll need to register the new entity, whether it's one company or a new company. As I just mentioned, you'll need a new ABN and TFN for the entity. Then you've got to move all of the business assets, contracts, liabilities, the name, any intellectual property. If there is employees, in one structure moving to a new structure, they've all got to move across. So you've got to transfer all your assets, liabilities, and contracts, and notify all your different stakeholders. As part of that process, hey, we're moving to a new company. Can you re-sign our agreements because there's a new operating company that's going to be conducting business. You then got to make sure your taxes and superannuation requirements, if you've got employees, and all those sorts of things are under control. And if there's some, depending on your industry, sometimes there's different requirements for company structures versus individuals. Certainly in legal where we operate, if you set up a company, it's quite different to if you're just a partnership. So got to just check that there's nothing you have to change operationally around that. And then finally, it's all of the operations, updating your bank accounts. If you've got a new name, the signage, and as we mentioned, payroll processes. So these are the kinds of considerations, a bit of administration. And as you can imagine, the earlier in your business journey you go through this process, the easier. You may have less contracts, less stakeholders. If you wait until you're larger, it becomes a pretty to, for example, if you're moving to a dual and you need to move entities, getting everyone to sign a new contract or contacting all your suppliers and getting things to change over, moving all your software subscriptions over, it can be a bit of a headache. So, but it's doable. So this is just, I guess, worth keeping in mind if you choose to not set up the structure of the future for your business right now. This road may lie ahead, and certainly in the case of certain trust structures, there can be significant tax advantages to having the structure with the trust from day one. If you migrate to a trust structure later on, and again, shareholders need to sell shares to their trust to move from this to this structure, there can be expensive tax costs to make the migration that wouldn't have existed if they did it from day one. So again, if you're thinking, we're going to be a larger business, or, I think in the future for various purposes, I want to introduce trust into my structure, you might get some advice now as to what the benefits might be for your type of business and whether it is worth incurring those more significant costs for the future. And again, oftentimes for at least startup companies, and when I say startups, I mean companies that are small but looking to scale very large and become 100 plus, 200 plus person companies. For that portion of our client base, it often makes sense to set up the trust structures from day one because it becomes a lot more complicated pretty quickly. Whereas for smaller businesses growing at a smaller pace that may not be quite as growth focused, you may be able to take your time a little more. But again, it all depends on your specific circumstances. Rishi said, is it possible to own telephone numbers and website, etc., in holding company? Yes, it is certainly possible to. The holding company is really a colloquial name. It's not really a legal concept. It's just a name that we use to describe an entity that doesn't do anything except holds core assets. But it can do whatever you want it to do. It could have its own Microsoft Word subscription if you wanted it to. It's just not recommended to do too much in it because you want to keep it safe from risks. But it's very common to hold your IP, your business brand name, which we're about to talk about, and your website domains in your holding company. Because again, those are core assets that you want to protect from risk. Can you transfer losses under company taxes as well? I'm not 100% sure what you mean by that question, but if you move from a single to a dual company structure and you have accrued losses, it's probably a question for an accountant as to whether you can transfer those losses from one entity to another entity. I believe you can, but I think there's some tax laws around transferring historical losses. And again, if you're talking about from a sole trader to a company structure, probably a similar answer. I believe it is possible, but there's some process that needs to be followed. And yeah, we got a question about listed legal documents. I'm glad you asked that because in one slide's time, I do in fact have that list of legal documents. So we'll come back to that one. So just a quick note on business names. This is a topic that there's a lot of confusion about. People, when you register a company, you choose a name, but there's something else called a business name that you register. And then people have heard of trademarks, and people are very confused because a lot of our clients think, oh, okay, I own my name because it was the name I chose when I set up my business. It's mine. Unless you register a trademark, which is a separate thing. And for those that aren't sure if they registered a trademark, there's a good chance you didn't because you're likely to know if you did. You don't actually own your name. So there's 3 registrations in relation to names that you've got to be aware of, particularly in a company context. One is your company name. So for example, we're called Sprintlaw Pty Ltd, or a holding company is Sprintlaw Holding Pty Ltd. That is the legal official name of your company. That may or may not be the same as the name that goes on your signage, your logo, your website, your trading name, as is colloquially known, or officially business name. Your business name is the name that you use to display yourself to the public. So for us, that's Sprintlaw, which is different to Sprintlaw Pty Ltd. We could register another business name called Law Patch or something, and we could start a business and start trading, under Law Patch as well. It would be owned by it will be controlled by the entity Sprintlaw Pty Ltd. But for legal purposes, if we want to start conducting business under a different name, we need a separate registration. So pretty much always when you register a company name, you also, if you're running a business with that company, want to set up a business name too, separately. It's cheap, it's easy, it's quick, but it's a legal requirement. The name that you go out to the public with must be registered with ASIC. Now, just because you've registered that name with ASIC doesn't mean actually that you own it and that no one else can use it. And in fact, it might not even mean that someone else isn't already using it and you could get in trouble separately under IP law. So a trademark is a separate concept where you register the exclusive right to use a name, phrase, or logo in a particular class, in a particular country, in a particular industry. And for example, we've registered the word Sprintlaw and our little S logo as a trademark in the legal class or industry. What that means is no one else in the legal industry can operate or create a product or service called Sprintlaw or anything deceptively similar to it, Sprint Legal, Sprint Lawyer, in Australia in the legal class, nor can they start a legal business where they're using something that looks like this S logo. So it's in a sense a narrower because it's industry specific, but stronger protection for your brand name. It's not a legal requirement that you get one of these things, but if you're investing time, money, effort in your business brand name, you want to make sure you've got it registered as a trademark to stop, someone starting, whether it's a company or even just a product with a name like yours or slightly similar to yours. You don't get that protection through just the business name registration. So we do, I think, have a webinar coming up with IP Australia where we go into this topic in more detail. So for those interested in trademarks and IP protection, I'd suggest you come along to that. But just important to remember, just by registering your company and your business name, you don't necessarily own it. Okay, and just onto the final slide. I know we're at time, so I may just go a few minutes over. And for those that need to drop off, we will distribute a recording of this if you want to catch the last couple of minutes. The key legal structure documents, we had a question earlier, what are the documents that actually need to be put in place to make all this stuff happen? Depends on your structure, but if you're a sole trader, you don't really need any structuring documentation. You, of course, may still need terms and conditions and privacy policies and all that stuff, but in terms of structuring documentation, it's just you, so and it's quick, cheap, and easy, so that's one of the advantages. If you're a partnership, it's pretty light. You just need a partnership agreement with the other business partners to describe who's doing what and how it works and to formalize the partnership. Once you set up a company, there is a suite of documents that you need. One is a company constitution. This is like a governing document that just explains, okay, we're setting up this fictional legal person called a company. Here's how it works. Here's how meetings are run. Here's how it's shut down. Here's how it's set up. A bunch of administrative affairs in terms of how the company operates. It's fairly templatized now. And most of the time, if you use an online setup service, or you do it through us or an accountant, you'll be given a template constitution, which is fairly standard. There's a company register. You're required to keep by law a suite of documents. Who are the owners of this company? Who are the debtors of this company? Et cetera, et cetera. Again, there's a template document pack that's often provided when companies are set up, and either lawyers or accountants as a service can help you maintain that register. But you need constitution and to maintain this register of who actually owns this thing and how does it work. Then we've got a shareholders agreement, not required, but strongly recommended. This is a contract between all of the different owners of the company, discussing a bit different to the constitution, which is more administrative in nature. The shareholders agreement discuss what happens if someone wants to leave the company. What happens if one person wants to make a decision, but the other doesn't? What happens if someone passes away? What happens if we want to raise funding? What happens if one person wants to sell part of their shares to someone else? All these machinations that can happen in business, where you've got multiple stakeholders that may have differing interests over time, that gets enshrined ideally in a shareholders agreement, and so everyone understands how the business is going to work. And it's kind of like the business marriage document. It's really, really highly recommended by us if you're setting up a company to do one of these. And again, if I think we had a question earlier with some people leaving and some people staying, the shareholders agreement would have a nice process that explains exactly what's meant to happen when that process kind of emerges. So it's just a private contract between the shareholders. It's not actually required, but again, we recommend pretty much 100% of people running a company with more than one person do a shareholders agreement. A directors agreement, there's we had a question earlier, are directors ever personally liable? The answer is sometimes yes. Sometimes you have a private contract between the director and the company, which says, in the off chance that the director is personally liable, the company agrees to cover all the director's costs. So that can help protect against that eventuality. Again, often recommended, particularly in medium-sized companies where directors may not have full visibility of what's going on and may be a bit worried about accidental breaches of some of their duties. And finally, there's more of a housekeeping document, but when you have a dual company structure, you need a document called an intercompany license that explains how these two companies interact. It's quite technical, so I won't bore people with the description, but just be aware it's an extra document that's required. And finally, if you're adding on a trust or working with a trust, there's a couple of additional documents, a trust deed to set up the trust. And if you do a unit trust, which I touched on earlier, there's also something called a unit holders agreement. So yes, there is a suite of documents. A lot of these are quite straightforward. Again, there's tons of companies out there, so a lot of them are templatized. And I would suggest not really DIYing any of these documents and using online templates for them. They're just important structure documents. Email disclaimers, sure, you might want to produce those yourself, but like your company shareholders agreement, it's quite important. So I would get proper advice, whether it's from us or someone. It's a really great idea to get this done properly. So that is all of the content for today's presentation. I hope people found this useful, educational, and so on. Just a reminder, if there's any services that you need or any help, we do have this kind of end of financial year discount offer, so do feel free to reach out to the team. If you've got any feedback or topics that you want to hear about, do let our team know. And it's always great to know whether this stuff is helpful or not. Otherwise, all the best. Thanks for attending, and we'll hopefully see you next time. Thanks so much.